I'm going to regret this. Hey, welcome to Sizeable Personal Finance. Today we're going to talk about how to get money without actually selling a property, and it's called a home equity loan or a cash out refinancing. Whatever it's called, you are essentially borrowing money against the value of your property and then getting cash out that you can use for whatever purpose you want to. So let's say you feel like markets are very attractive, you want to invest, or you have some loans that are of higher interest you want to pay off first, or maybe you want to start a business or buy a car. Just kidding, don't buy a car with money you borrow from your place. Right, you can actually use home equity loans to get cash, rather sizable amount of cash, so that you can use it towards whatever purpose you want to. So in essence, people who are cash strapped or need the money for some reason or another don't actually have to sell their property. They can always just take out a home equity loan, and they have money for their cash flow issues and still remain under their roof. Do note that this option is only available for private property and executive condominiums after the 5-year MOP. HDB flats are unfortunately not allowed, because MAS does not allow people to borrow against the value of their HDB flats. Before we continue, usual disclaimer, this is not financial advice, so don't go and refinance your property because Seth said so. Go and do your own due diligence and research before any financial decision. Now, why would you want to borrow money against the value of your property? Number one, you can get quite a bit of cash at a very low interest rate. Because the collateral is your property, mortgages are actually very low on interest rates, and therefore, if you can use it to get a higher interest rate, you are actually earning the difference. So that's a good reason why we want to borrow money. Whenever telemarketers call me about balance transfer, I actually answer and ask them what's the best EIR they can provide, and if the EIR makes sense, I actually borrow, and then I use that funds and generate some returns. And yeah, I've earned quite a bit of money this way by taking advantage of cheap funds. So when it comes to mortgage, you can get a much bigger amount of money compared to balance transfers, and it's for a much longer tenure because your property is usually paid over 20 to 30 over years. Think about it this way: if someone were to give you $100,000 and say, okay, I'll lend this to you, and every year you just pay me a small amount of interest, would you take that loan? I would definitely take it, because I feel like if the interest is low, I can always earn money by investing that sum of money and then giving that person a low interest rate. Now, even if you're not in need of money, I feel that now is a time for you to refinance, because interest rates are of course going up and you want to lock in a lower interest now. But when you are refinancing, I think most people will just go the normal refinancing and just continue to pay down their mortgage. But I think you should consider doing the cash out refinancing instead, because having a lump sum of money with a low interest rate unlocks a lot of possibilities for yourself. Number three, mortgages are long-term affairs, anywhere between 20 to 30 years, which means even if you borrow a significant amount of money, your monthly payment is still relatively small, and also you have that time horizon for your investments or whatever plans that you're using the money towards to grow and bear fruits, such that it makes sense for you to borrow money from your property value. Now, if you want a comparison against the different mortgage packages in Singapore for the best rate available, check out the link in my description below. Sign-ups may earn me an affiliate fee, so I thank you for feeding Kylo and me. My friends have been saying that Kylo and I have been getting skinnier, so yeah, right, help us out. So what can you use the money for? Personally, I've reached the point where I can refinance my mortgage, and I'm opting for cash out refinancing and getting a lump sum of around $100,000 so that I can invest and earn the difference between my investment returns as well as the mortgage interest. Now, while this sounds risky, consider that my next 2 years is fixed at 1.5%, whereas the latest Singapore savings bond actually gives 1.91% for 2 years. So essentially, I can just take this $100,000, put into SSB for 2 years, and just nothing, I earn the difference between the interest rates. And that's not what I'm going to do, but it's just an example of what I can do. I will be actually using the money and investing over the long term, because I have a 30-year mortgage anyway, and over that long time span, I feel that I can definitely beat the mortgage interest rates just by putting it into an index fund. Yeah, I think that will actually earn me a profit over the interest rates over the next 10, 20, 30 years. I don't see myself losing money in that time horizon. As usual, if you like my content, I'm playing the YouTube game again and asking you for your important like. Other good uses for the money would be if you have higher interest loans that you need to pay off, for example, credit card debt, or just about any other loan that's higher interest than mortgage loan. And I think that's basically every other loan, because mortgage interest is so low compared to other types of loans. Rather than paying 5, 7, 21% interest on those loans, you might as well refinance now, get about 1.5 to 1.8% interest, and then pay off the higher interest loans that are sucking your savings dry. When it comes to borrowing and loans, cheap debt like mortgage interest is good, and expensive debt like credit card interest is bad. So yeah, just balance accordingly. I think it's a no-brainer. Of course, you're not restricted in how you want to use the money. If you want to buy a car, or you want to throw a party, or whatever you want to do with that money is up to you. But do take note that if you fail to pay the mortgage repayments, your property will obviously be repossessed by the bank. So that's the risk you're taking here. And of course, after your fixed rate has expired, your interest rate will also go along with the prevailing interest rate at that time. So yeah, there is some risk that interest rates will continue to rise, and then you are now borrowing a larger quantum of money and therefore pay more interest on your mortgage. But really, I'm not worried at all because again, it's over a very long time horizon, and I'm someone who's relatively risk averse, and I still feel super comfortable taking a mortgage loan out, pay them down over the next 2-3 decades of my life, and using the money towards other investments. I will always borrow as much money as I can on a mortgage loan because they are very cheap debt. Note that you can only borrow up to 75% of your property value, also known as the LTV or loan to valuation limit, and minus off whatever you still owe the bank, as well as sums paid by your CPF OA. And as usual with bank loans, you need to watch out for your TDSR, meaning to say that your total loans cannot exceed 55% of your gross monthly salary. Also, when it comes to refinancing, you need to pay legal fees of about $2,000 to $3,000 and valuation fees of a few $100, depending on the property type. But these fees are usually paid for by the bank subsidies because they give incentives to attract you to be a customer, and therefore you actually pay a lot less because of the subsidies. Do take note, there is a clawback if you sell the property within 2 or 3 years, okay, and this depends on your bank's terms and conditions. Personally, I have vague plans to move or buy a new place in the next year or so. But I have no firm plans yet, so if that really happens, then I'll just pay back the clawback amount of, I don't know, $2,000. Yeah, it's not devastating if I really want to change homes at that time. So I told my parents this. I think they were a bit against the idea because, I think older generation, they tend to be very risk averse. They feel like debt is not good. You should always repay your debt as quickly as possible. But at such a low interest rate, really, I feel that that is like as good as free money in a way, right? Because I can always invest and earn the difference. And even if interest rates increase, I feel that your returns from other instruments will also tend to increase as a result. And therefore, this is a very safe thing, I feel, when I stretch it out over the next 20-30 years. And you should refinance if you are able to fix your interest rates for the next 2 or 3 years because it is rising, and therefore you want to lock in a lower rate. What about you? Have you heard of cash out refinancing before? If not, will you be considering this now that you watched my video? Let me know your thoughts in the comments below. Are there any risks or downsides that I've overlooked? Also, okay, same thing, comment box, right? And okay, if you like my content, please drop me a like. Go to my Telegram group and subscribe. Okay, usual stuff, okay? And I will see you next video.